What's up, future CPAs of the Philippines? Look, I know you're getting ready to crush the board exams, so let's get straight into a topic that you absolutely have to master: EBIT EPS indifference analysis. Trust me, this isn't just for the LECPA. You're going to use this logic for your entire career.
Okay, put yourself in this situation. You're the advisor to a huge company. They need like 1 billion pesos for a massive new project. The big boss looks at you and asks, so, do we borrow this money or do we sell off a piece of the company to get it? Yeah, no pressure, right? This isn't some random textbook question. This is the real deal, a high-stakes call that business leaders make all the time.
You know, it all boils down to this. Every company needs fuel to grow. But where do you get it? Taking on debt is like having a fixed payment, sure, but you get to keep all the profits. Selling equity, on the other hand, means you're sharing those profits. But hey, you're also sharing the risk. You can see how getting this wrong could be a total disaster. That's exactly why we have a tool to help us make the right call with, actual numbers.
Okay, so here's our game plan. We're going to start with a super simple analogy to get the main idea. Then we'll meet our two best friends for this topic, EBIT and EPS. After that, we dive into the main event, the calculation. We'll find that magic indifference point, talk about the risks involved, and wrap it all up with a lightning-fast review that's perfect for your LCFPA prep. Let's do this. All right, first up, let's make this whole thing less intimidating. We're going to break down this huge choice with a simple analogy you can actually relate to.
So, think about your phone plan. Seriously, debt is kind of like that unlimited data plan. You pay one fixed price every month, right? That's your interest. If your company is killing it, like streaming 4K videos all day, generating tons of profit, that fixed fee is a total steal. All the extra profit, it's all yours. Now, equity, that's more like a pay-as-you-go plan. No fixed fee, which sounds safe. But for every bit of data you use, every peso of profit you make, you have to share a piece of it. See? It's a pretty solid way to frame this huge decision.
Okay, concept down. Now for the numbers. Let's introduce the two key players in this whole drama, EBIT and EPS. These two metrics are everything.
So first up, we've got EBIT. That stands for earnings before interest and taxes. Think of it as the company's raw, unfiltered profit from just doing its business. This is the money it makes before it has to pay the bank any interest or the government any taxes. It's basically the whole pie that we get to slice up later. And if you look here, you can see exactly where it fits on the income statement. It comes right after you've paid for all the operational stuff, but before financing or taxes mess with it. So that $350,000 you see, that's our starting point. That's the pool of money we're working with.
Okay, our other hero is EPS, which is earnings per share. This is the bottom line, the number that shareholders really, really care about. After all the bills are paid, interest, taxes, everything, this is the profit that gets assigned to every single share of stock. The whole point of this exercise, and really a big part of finance, is to make this number as high as possible.
Okay, now for the main event. Let's get to the core calculation. We're about to find that one specific, magical number where a company literally wouldn't care if it shows debt or equity. This slide is the whole engine of the analysis, so pay close attention. Look at the two formulas. For the debt plan, on the left, you see we take our EBIT and subtract the interest payment first. Then we deal with taxes. For the stock plan, there's no interest to subtract, which is cool. But look at the bottom. We have to divide the profit by more shares. So one plan hits your profit, the other hits your share count. So, what's the goal? Super simple. Find the exact level of EBIT that makes the EPS from the debt plan equal to the EPS from the stock plan. That's it. That point where they're identical, that's our indifference point. And honestly, the algebra isn't as scary as it looks. Step 1, you literally just set the two formulas equal to each other. See that 1 minus t part? Since it's on both sides, poof, you can just cancel it out. Makes life way easier. From there, it's just a matter of solving for EBIT. And boom, that number you get is the indifference point.
Okay, let's make this real with some numbers. Look at the top row. When EBIT is low at $500,000, the stock plan gives a better EPS. Why? Because that fixed interest payment on the debt plan just eats up too much of a small profit. Now look at the middle row. At our indifference point, $1.8 million, they are perfectly tied. But then check out the bottom row. When profits are high, that debt plan suddenly crushes it. That's the power of leverage at work. This right here, this is your key LECPA takeaway. You have to remember this. If you think the company's EBIT is going to be above that indifference point, debt is the way to go. It magnifies your earnings. If you think EBIT will be below that point, stick with the safer option, equity. Got it? Good. Okay, but wait. If you just stop at the calculation, you're missing half the picture. The math gives you a number, right? But being a great CPA is about more than just crunching numbers. It's about wisdom, and that means we need to talk about risk.
So debt is awesome when profits are high. It seems obvious then, right? Just get a ton of debt. But if it were that simple, wouldn't every company be drowning in loans? So what's the catch? What are we missing?
Here it is. That interest payment, it's a promise you have to keep. It doesn't care if you had a great year or a horrible one. You must pay it. Piling on too much debt cranks up your financial risk to dangerous levels. It can lead to something called financial distress, which is when everyone, your customers, your suppliers, starts getting worried about you. In the absolute worst case, insolvency. That's the fancy word for you can't pay your bills anymore.
And of course, because we're accountants, we have a way to measure this risk. It's called the degree of financial leverage, or DFL. Think of it like a risk meter. It tells you exactly how sensitive your EPS is to changes in your EBIT. A high DFL is exciting. It means good times are great, but it also means bad times are absolutely devastating. It puts a number on that double-edged sword.
All right, let's pull it all together. Time for your rapid-fire LECPA review. This is the stuff you need to lock in your brain for exam day. Ready? Okay, here's a study hack. Just picture a simple graph in your head. The stock plan line, it starts higher up on the vertical axis, right? Because there are no fixed costs. The debt plan line starts lower, but its line is way steeper because of that leverage. The exact spot where those two lines cross, that's your indifference EBIT. Easy way to remember it.
All right, here are the core concepts. Burn these into your memory. 1. EBIT is operating profit. 2. EPS is what the shareholders get. 3. The indifference point is where EPS from debt equals EPS from stock. 4. Above the point, debt is better. 5. Below the point, stock is better. And 6. More debt equals more risk, which we measure with DFL. That's the list.
And if you need that perfect textbook definition for your notes, here it is. This is the official language. Take a screenshot. It's just a fancy way of saying it's the EBIT level where EPS is the same for different financing plans.
So I want to leave you with this question. The analysis tells you the exact crossover point. But as a future CPA, a future business advisor, how do you help a leader decide how much risk is too much? The numbers only tell you part of the story. The rest is about judgment, strategy, and understanding the business. That's what separates a calculator from a true advisor. Something to think about. Now go ace that exam.